The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we saw a fairly quiet day in midweek on Wednesday. A little bit of green in the soy complex once again. Quart of wheat a little lower. Nice higher move in live and feeder cattle futures as well. And a decent rebound in some of the outside markets amid a cooling of tensions, I would say, or at least that's what's being reported in terms of U.S.-China relations, Fed Chair Jerome Powell, and much more. Let's talk about all of this. We got to look at the weather as well. A lot of different things to take a close look at here today with Mike Zuzolo from Global Commodity Analytics. And Mike, it is good to catch up with you again. Gotta say, a fairly quiet day on Wednesday, it felt like for the most part. And I think some of that headline news risk tied with weather, some of the main drivers, I think, across that grain complex, Mike.
Yeah, post-Easter holiday trade has kind of shown us that the trade is feeling better about the U.S.-China trade relationship. And Tuesday afternoon rumors followed by a big Wall Street Journal report at midday on Wednesday today about President Trump's administration potentially cutting tariffs to China as much as half of what they are right now, maybe even more on some items, was reported by Wall Street Journal. These things, I think, added to the flavor that let's go ahead in the trade and buy the beans back and probably sell out of the long corn and long wheat. I'm not a big fan of this price action right now, Jesse, because we've got the wrong leaders in the market. But between the crop conditions for the winter wheat being, at 45% good to excellent versus 50%, and some substantial drought issues in the Western Corn Belt and the hard red wheat belt, I'd really prefer the wheat and the corn to be leading this market higher. Having said that, if the trade is really bogged down or has been bogged down by the soybeans and by the U.S.-China trade relationship, I would have expected this market to react a lot better with this kind of news. And I will say, I have not heard much out of the White House as far as confirming this Wall Street Journal report and others now reporting that the Secretary of Treasury has said a couple things in the past couple days at private meetings. So maybe that's what the trade's waiting on. But I can tell you by Friday afternoon, with that 1049.5 high that we put in soybeans last week, and it was a 2-month high, I'd really like to be screaming through that by Friday's close if these rumors or these reports indeed end up being correct.
Well, and to your point, we kind of faded the soy complex a little bit off the highs of the day into the close. So not great price action overall. I have to think, though, set aside the headline news and more here for a second. And you mentioned weather. Let's talk about that, because outside of all the headline risks, the weather's got to be the key driver here. And I know there's some concerns about drought still lingering. We're trying to get rolling with spring planting and more. So frame this up for me post-Easter here. What are your thoughts on the weather picture and some of the advance in spring planting that we're seeing?
Yeah, great question. And I think this is where it goes back to the top 3 areas to be watching weather has been South America, the Black Sea, and the United States. It seems to me with this last full week of April being put in the books right now, that we are going to straighten out some in the U.S. We have straightened out in the second crop corn, safrinha corn in Brazil. The Black Sea is still very much an issue as far as losing production without a change in weather pattern. So if we keep that in mind and then we look at this map, we have seen models depict a lot more rain than we've actually gotten. And to just give you an idea anecdotally, Jesse, of what I'm hearing, I've talked to more than a half a dozen clients this week in each side of the Corn Belt, east-west of the Mississippi River. They're just starting to pick up the pieces from the rains east of the Mississippi River, like Illinois, Kentucky, Indiana, getting going on high ground again. But in Nebraska, Kansas, I just talked to a client before going on air with you that's down by Kansas City, and he is completely done, record pace and getting done, and others are completely finished up with both corn and beans. And so to kind of put all this together, I think we're losing our weather market potential in the short term because the rains are supposed to be coming here in the next 10 days. But if those rains are missed, and some of the private forecasts that I've seen and I purchased coming out for May continue to suggest that we're going to be hot and dry west of the Mississippi River, we could be right back in the weather market in the United States again. So that's the dance we're dancing. And I think that's why the spreads have been so active, but the flat price market has not. And in fact, we're dancing within a nickel now, I think, in soft red wheat as of Wednesday's close, of making a new monthly low. And that just doesn't jive with this map, especially with hard red wheat kind of leading this market in terms of declines.
So with some of that in mind, that maybe points to some of this choppy grain market action here the first few days of this week, waiting to see if those rains verify, essentially, Mike.
Yeah, exactly. And I think we put together the weather and the rains, and then President Trump's cutting the Chinese tariffs, and then we see what kind of soup that makes and how we close on the weekly close. Weekly charts, to me, are the most important charts compared to the dailies or the monthlies right now.
Well, let's talk soy, and I want to look at the soy hog spread with you first. We talk about this quite a bit. It's been a while since you and I have talked about the pork and bean trade, though, but walk me through what you're seeing in this chart. Pretty clear correlations, just to my eye, between soy and lean hogs right now, and just walk us through this spread action that you're seeing.
Yeah, and the reason we haven't talked about it much, Jesse, is because the soybeans have been mostly in decline as the hogs have been rallying these past several weeks, and especially the last 2 weeks. Well, now we're starting to see the soybeans curve higher with the hogs. And so this is a footprint chart for me. It validates whether the trade is trading China or not. And if they're both going down at the same time, then we're negative China. If they're both going up at the same time, we're positive China. So this is the first time I can see in a weekly chart that we're getting some type, or a monthly chart, that we're getting some type of correlation again between the soybeans and the hogs, which suggests, yeah, they're trading again together and in a positive manner. And so the trade's getting more optimistic about China. I've really been struggling with the soybeans right now because I've heard a lot of bullishness about the bean oil and the sustainable aviation fuel, but I've seen nothing come out of Washington. I've heard a lot about other, motives for the bean market to rally. The monthly charts are oversold, so you do have some shorts in that market. But how do you get around those record world ending stocks numbers and the idea that we're probably going to see 14.5 million metric tons of soybeans shipped out of Brazil this month? Mm-hmm. And it's just a really tough situation. So beans need friends right now, and that's why I keep track of this chart.
Well, and especially if we think about new crop beans, looking at that November soybean seasonal, that's been an area where we've had all this talk about corn acres, over soybean acres and things like that. And so, I mean, when you look at Nove beans in particular, what stands out to you there?
Well, what stands out to me about the futures market is if we do have the futures rally, and after the acreage report, we did not see any basis pop hardly at all. Now, I did talk to an Indiana client today, and he said his new crop basis for October had gone from 55.60 under to 35 under. And so it did pop quite a bit for him. But what I've kept track of mostly, like whether it's Illinois, Nebraska, Kansas, wherever, it's not really come up at all. And so we're still sitting at a 60 to $1 under fall basis for the soybeans. And so it's starting to set up for me with the mindset we could see a futures type rally. I'd really want to sell into that on the futures only side and leave the basis completely open heading into early midsummer, just because of what we just got done talking about when it comes to the weather pattern that we're under right now. So when I look at the basis, it says we've already priced in a big South American crop and then some, and probably some negativity in the tariffs. So is the basis the first thing to rally? And that's why the futures market hasn't been rallying. So trying to put all these pieces of the puzzle together, because we still have a lot more questions and answers right now. But on this chart specifically, 2025 is really tracking well with the average. The white line is the average of all those years that you see there. And so 2025 is really tracking well with those relatively tight U.S. supply years, but maybe a little bit more questioning on the acres and questioning on the demand side.
We're having a conversation today with Mike Zuzolo from Global Commodity Analytics here on Market Talk. Mike, real quick, corn and wheat trade, again, a little bit weaker here. Really this week, it's felt that way coming out of the Easter holiday. Any big notes for you when you look at corn and wheat right now?
Yeah, I'd be surprised if the July D's corn spread would break down. It's still around 23, 25 cents premium July, Jesse. We had great ethanol numbers today on the weekly numbers. We continue to see corn planting issues in the central and eastern corn belt, and the demand is not backing down on the export front. I also took note, and this is a biggie, if we're going to have to replace China with demand, we really want to replace it with India. And I noted that Vice President Vance talked specifically about India taking more of our ethanol and when he spoke publicly in India. So I'm watching that very carefully and very closely, but I would be disappointed if the July broke to the December. That could signal maybe the top is in and we're heading into more of a normal corn crop year that we're going to rebuild supplies.
Anything concerning on the wheat side, too? I noticed that winter wheat ratings did tick a little bit lower this week, but that seems normal to me, Mike. I don't think there's any alarm bells to have there, is there?
No, not yet. We do have 5 to 6 of the big states at 20% or greater. Very poor conditions. That's worth watching in the next 30 days. All I can say with the wheat, Jesse, is with the hard red and soft red within a dime or a nickel of some of their major lows, and I think we're within 50 cents of 3-year lows on some of these wheat contracts. There's just no weather premium in it, and I could really see if the Russian ruble started to go higher and the Black Sea weather stayed dry. I could really see where the wheat downside would be very, very limited. I'm not going to call a rally. I don't have any boxes of Kleenex left yet at this point after crying over the wheat market. But I would love to see the wheat market stage some type of short covering rally, because I still, at the end of the day, see it as my leader to the upside.
All right, let's go to livestock. Another good day in futures on cattle Wednesday, both fats and feeders. Let's start with this feeder cattle complex. Looking at the monthly chart, starting to see a nice defined uptrend here a little bit, continuing. I mean, walk me through in this feeder complex, what stands out to you right now?
Well, yeah, when you look at this monthly chart and you look at that yellow line, we're talking about the last, 9 months. And what really we have to remember is the last 8 or 9 months, feeders have led the fat cattle higher. They've led the fat cattle in futures. They've led the fat cattle in terms of cash markets and enthusiasm as well. We've recoupled that again in this short-term price action. The feeders were the first to bounce, even though I would call the placements number and the on-feed numbers from the last cattle on feed no better than neutral. But feeders have gotten back on it, and it's been mainly due to the cash market. And so I think that's the real key market to be watching here if we are getting ready to seasonally top. And I'll say it very plainly during this show, since we've talked about a lot. Going into the end of the month, Jesse, the two biggest commodities I'd really like to get some hedges in place for would be soybeans and would be cattle, because they both had good runs, and the supply-demand fundamentals to me seem a bit out of whack heading into what typically could be a negative seasonal time period.
How about over in that feeder fat spread? Let's take a look at that and break that down. We've been tracking this the last several weeks, and here we are again, pretty much staying with the current trend between the two right now, it looks like, Mike.
Yeah, it's really neat to see this chart because the fat cattle have come on later than the feeders, to my point a minute ago, and that now has curved down the feeder fat spread, with the May feeders now lead month doing some of that work because it went off. It came on at a discount versus the April. There's still a chance with the gap in the daily chart and lead month feeders continuation chart to maybe ring the bell of that 290 area that the May feeder contract high was at back in March. That's another key area, but this chart supports the idea that the feeders maybe are getting a little bit tired here, and seasonally it gets a little bit harder to rally as May takes over as lead month futures because of that stalker market. And a lot of the buying, I think, is just starting to fizzle out at this point. We're going to be buying for retention, I think, at this stage instead of marketing feeders later down the road. The profitability in the back end fats just doesn't seem to strike me as that great right now.
Well, and I wonder too, I mean, you think about the cash market, and we'll pull up our last chart we have on the video feed looking at boxed beef. And, I know last week there were some bids passed at 212 in the north, and you think about some of the different dynamics on the cash side and with the cutout and more versus the retail demand and things like that. I mean, there's some interesting things I think to track there, and one of them for me is going to be more on the retail side, because the cash side seems like it's continuing to stay relatively strong, healthy, whatever term you want to use. It just seems to be continuing on its trend here as of late, Mike.
Yeah, and it's going to be a battle between the Wall Street jumping, because we still have such a sensitive market because of that strong cash market you're talking about. The trade's very sensitive to Wall Street, and so we've had a really good couple days in Wall Street. That's really helped the shorts get out of the way in the cattle and the feeders, Jesse. But at the same time, we're seeing a very big rally in the dollar. And so if I had to choose over the big picture, 2025, heading into summer grilling season, what's the better of the two to have on your side? I'd much rather have a weaker dollar than a stronger stock market right now at this stage of the game, because there are a lot of imports out there waiting to be brought into the United States. And there's a lot of imports like Australian beef imports that are ready to go into China instead of them buying from what we may have or may not have. But it's a really critical time period. It's a situation where this boxed beef price, again, seasonally, has a little bit more difficulty going higher in this next 30-day window. I could see a real good reason to be hedged up in cattle and soybeans heading into the 1st of June, and then reevaluate everything once we get to June, because then we'll be talking drought or no drought. And to your point about the cash market in the cattle, we do know that between the marketings number and the cattle and feed report and the dressed weights jumping 2 pounds last week on the weekly kill, packers are doing an effective job of backing up the marketings. Mm-hmm. So we still have about 75 days of ample supplies here domestically.
And I'm hypothesizing a little bit, but I've heard some chatter from ranchers that they're still not seeing a lot of heifer retention out there. And I believe that last cattle on feed, I think we had quarterly numbers out with that too. I mean, but when you look at some of the numbers and you talk to clients, are we seeing that heifer retention yet out there in the countryside?
I think we are. I think it's a little bit hard to find the data to confirm it at this point. Mm-hmm. But I would also say that, to your point, the marketings number to sell feeders, lightweight feeders, they've been on fire. Why would you want to keep them, and why would you want to feed them out in terms of and why would you especially want to retain them? Because you do much better on feeding them or getting them sold as heavier fat feeders, or let them go as fat cattle. Mm-hmm. I think the job and the function of the market is to now get cattlemen and ranchers to want to retain. And that's what I don't like about those the back end prices. So to your point, we're probably not doing enough retention, but I think we are doing some.
Okay. You mentioned hogs earlier a bit with the soy hog spread. Any other notes for you in this lean hog complex this week, Mike?
Well, the key with the hogs continues to be disease pressure and China demand. And right now we've got both of those kind of simmered down and cooled down. I was expecting a hog high probably about a week or two ago. We've been able to extend that. So I think we're running on fumes at this point, unless we get some new information to kind of feed the bull. And maybe it's the tariffs coming off. Maybe it's a U.S.-China trade deal. But I think we are at a stage now where the hogs, we probably need to feed the bull in this post-Easter mindset.
All right. I'll throw it to you for final thoughts this week. What would you mention or reiterate to folks today?
Just that I would say concentrate on those May feeders, see if they can bring that 290-60 bell, that old high. And if they can and they don't go through it, look at getting some hedges in place. Same thing with the beans. If we can't break into new monthly highs and two-month highs, that's only 2 or 3 cents away, given the news that we're getting right now, maybe worth getting some protection on.
All right, Mike, I know you have a lot of great resources on your website. Folks can contact you easily there, et cetera, et cetera. How can folks get in touch?
GlobalComResearch.com, and it's GlobalCom with 2 M's research.com. Sign up for a 2-week free trial.
globalcomresearch.com. Mike Zuzolo, Global Commodity Analytics. Always good to chat with you, sir. Thanks for joining us this week on Market Talk. Have a great one. We'll talk to you next week.
Thanks, Jesse. You too.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.